For 20 years, a single undisputed illusion governed the world of precious metals. It was the belief that the price of silver, determined by the trading of paper contracts in London and New York, was the price of physical silver globally. This system, built on confidence and infinite leverage, allowed the financial centers of the West to dictate the value of a strategic industrial asset. As of this morning, that monopoly is effectively over. We are witnessing a structural break in the global financial architecture. The spread between the spot price of silver on the Shanghai Gold Exchange and the COMEX in New York has blown out to unprecedented levels. We are seeing a differential of roughly $8 per ounce. When silver trades at $58 in Manhattan, it changes hands for $66 in Shanghai. In a normal market, this would be a simple arbitrage opportunity. Traders would buy the cheap paper contracts in New York, take delivery of the metal, ship it to Shanghai, and sell it for a risk-free $8 profit. This action would flood Shanghai with supply and bid up New York contracts until the prices converged, closing the gap. That is how free markets are supposed to work. But the gap is not closing. It is widening. This tells us something critical. This is no longer an arbitrage opportunity. It is a drain mechanism. We are watching a one-way siphon that is pulling physical capital out of the Western financial system and locking it away in the industrial vaults of the East. To understand why this is happening, we have to perform a forensic dissection of the two markets and the friction that has arisen between them. We need to look at the plumbing of the global silver trade, because right now the pipes are bursting. On one side, we have the London Bullion Market Association and the COMEX. This is the paper market. It is a market of promises. Billions of ounces of silver are traded daily, but over 90% of these trades are settled in cash, never involving a single physical bar. The inventory listed in their warehouses is often a complex web of leased, rehypothecated, and unallocated metal. It relies on the assumption that only a tiny fraction of contract holders will ever demand the actual metal. On the other side, we have the Shanghai Gold Exchange. This is a physical market. Its primary purpose is to supply the voracious industrial engine of China. When a contract is settled in Shanghai, the expectation is physical delivery. The buyers are not hedge funds looking for quarterly profits. They are solar panel manufacturers, electronics giants, and state-owned enterprises that need the metal to keep their assembly lines running. Their demand is real, immediate, and inelastic. The current $8 premium in Shanghai is the market's way of screaming that physical silver is scarce where it is needed most. It is the true market price. Stripped of the leverage and manipulation of the paper exchanges, it reflects the intense industrial consumption that we have documented, particularly from the booming photovoltaic sector, which now consumes a massive portion of global supply. So why isn't the arbitrage working? Why aren't Western bullion banks flooding Shanghai with metal to capture that profit? The answer lies in physical reality. The friction in the system has become insurmountable. To understand the break, we must look at the math of the trade. An arbitrageur looks at the $8 gap and sees profit. But between New York and Shanghai lies a minefield of costs, regulations, and physical hurdles. First, let's talk about the VAT, or value-added tax. In China, silver imports are subject to a 13% VAT. Usually, the SGE price quote includes this tax. However, even when we strip out the tax, calculating the net price, we are still seeing a spread of nearly $3 to $4 per ounce purely on the physical metal. This net arbitrage is the profit motive. It is massive. In the efficient markets hypothesis, a $4 net spread should be arbed away in seconds. The fact that it persists means the metal simply cannot move fast enough. Second, there is the standard mismatch. The COMEX trades the 1,000-ounce good delivery bar. It is a crude industrial brick, often 999 fine. The Shanghai Exchange prefers the 1 kilogram bar, often at 999 purity for high-tech applications. You cannot just take a bar from a New York vault and sell it in Shanghai. You have to refine it. You have to recertify it. This takes time. And right now, the global refining capacity is choked. The refineries are working overtime to process door bars from miners. They do not have the capacity to recast thousands of tons of Western bullion into Eastern kilo bars overnight. This bottleneck acts as a speed limit on the arbitrage. The West has the wrong kind of silver. Third, and most importantly, is the float crisis. To execute an arbitrage trade, you need float. You need available unencumbered metal that you can grab today and ship tomorrow. But look at the data. The registered category in the COMEX vaults, the metal that is actually available for immediate delivery, has plummeted to historic lows, hovering around 23% coverage of open interest. The rest of the metal is eligible, meaning it is privately owned. It is there, but it is not for sale at the current paper price. The owners of that metal are looking at the same $66 Shanghai price you are. Why would they sell it on the COMEX for $58? They wouldn't. They are holding it. Or they are bypassing the COMEX entirely and shipping it directly to the East themselves. This is why the paper price is stuck. The paper traders are selling contracts back and forth to each other, suppressing the price, while the physical holders have exited the building. This brings us to the core concept of this briefing, the one-way valve. Historically, silver flowed both ways. If London needed metal, Shanghai would export. If Shanghai needed metal, London would export. It was a fluid system. But in late 2025, the rules changed. While the situation in Mexico is driven by regulatory headwinds, the situation in China is driven by long-term resource management. China is the world's largest refiner of silver. They process the door bars from around the world. Historically, they exported substantial amounts of refined silver to the global market. But market reports indicate a fundamental shift in trade policy. On October 30th, 2025, new frameworks for the export management of silver were issued, effectively reintroducing a quota system for 2026-2027. This mirrors the supply chain adjustments seen with gallium, germanium, and antimony. While officially framed as a measure to protect resources and the environment, industry analysts point to resource security as the primary driver. China produces over 80% of the world's solar panels. They know the TOPCon math better than anyone. They know that to maintain leadership in the green energy transition, they need roughly 200 million ounces of silver per year, just for domestic manufacturing. Looking at the global deficit and the tightening supply in Latin America, the focus has shifted to internal allocation. Domestic silver stays domestic. Under the new licensing framework, priority is given to key industrial players. This effectively limits the flow of refined silver to international markets. This changes the risk profile for every Western bank. If a bullion bank ships metal to China to capture the premium, they lose control of that asset. They cannot easily get it back if a crisis erupts in London. This creates a liquidity trap. The metal checks in, but it doesn't check out. As a result, the only entities moving metal are those who intend to consume it, the industrial giants. They are draining the West of its liquid inventory. We are seeing a massive transfer of wealth. The West is suppressing the price via paper derivatives, effectively subsidizing the industrialization of the East. We are selling our strategic assets at a discount because our pricing mechanism is broken. We are also arbitrageurs of time. The market is currently pricing in a return to normal. The futures curve suggests that the spread will close, that supply will come online, and that prices will stabilize. But the data suggests the opposite. The spread is not an anomaly. It is a signal of a permanent repricing. The arbitrage of time is the realization that the price of silver today in New York is a historical artifact. It is a price that exists only because of inertia. The $66 price in Shanghai is the future price leaking into the present. Traders who understand this are not trying to close the gap. They're trying to position themselves on the right side of the break. They are buying physical in the West, not to sell it in the East, but to hold it until the West becomes the East, until the New York price is forced to snap up to meet reality. This snapback will not be gentle. When an arbitrage spread of this magnitude refuses to close for weeks on end, it indicates that the underlying asset is decoupling. We have established that the $8 spread between Shanghai and New York is a drain mechanism. Now, the skeptics will point to a single chart to try and debunk this. They will point to the total inventory numbers of the LBMA and the COMEX. They will say, look, there are still hundreds of millions of ounces in the vaults. There is no shortage. On the surface, they are right. The headline numbers look substantial. As of late 2025, the London vaults report holdings of over 27,000 tons. To the uneducated observer, this looks like a mountain of safety. But if you're watching this channel, you are not an uneducated observer. You know that in the world of bullion banking, ownership is a layered concept. We need to perform a forensic audit of these numbers. We need to distinguish between the visible stock and the available float. The difference between these two numbers is the difference between a functioning market and a default. Let's start with the COMEX in New York. The inventory report is divided into two columns, eligible and registered. A registered inventory is the metal that is fully warranted, available, and ready to be delivered against a futures contract right now. This is the dealer's showroom stock. Eligible inventory is metal that meets the purity standards, but is owned by private parties. It is stored in the vault for safekeeping, but it is not for sale at the current price. It is someone's private stack. Here is the smoking gun. The registered category has been bleeding out. Throughout 2024 and 2025, we watched the registered stocks plummet to levels that cover only a fraction of the open interest. We are seeing coverage ratios drop below 25%. This means that for every 4 ounces of paper claims demanding delivery, there is only 1 ounce of registered silver sitting there to satisfy them. The rest of the metal, the eligible pile, is just window dressing. The exchange points to it and says, "See, we have plenty of silver." But that silver belongs to long-term holders, sovereign wealth funds, and family offices who have no intention of bailing out a short-squeezed bullion bank at $58 an ounce. To access that eligible metal, the price has to rise high enough to convince those owners to sell. And judging by the $66 price in Shanghai, 58 is not the magic number. Now, let's cross the Atlantic to London. The LBMA vaults are the heart of the global physical trade. Historically, London held massive stockpiles, but these stockpiles have been eroding for 5 consecutive years. We have seen total holdings drop below 27,000 tons, a critical psychological level. But again, the devil is in the details. Who owns this silver? A massive percentage of the London silver is held by ETFs, or exchange-traded funds. When you buy shares of a silver ETF, the fund custodian buys silver and stores it in these vaults. This silver is allocated to the ETF. It is not available to the general market. It cannot be leased out. It cannot be shipped to Shanghai to close an arbitrage gap, unless the ETF investors sell their shares. So, when you strip out the ETF holdings from the LBMA total, what are you left with? You are left with the unallocated float. This is the pool of liquid metal that the bullion banks use to facilitate trading, clear transfers, and manage lease rates. Analysts estimate that this float has evaporated. Some models suggest it is near zero or even negative, meaning banks are leasing metal they don't fully possess. This explains the lease rates. In late 2025, we saw short-term silver lease rates in London spike dramatically. When lease rates spike, it means banks are desperate to borrow metal. They are willing to pay annualized rates of 5%, 10%, or even 30% just to get their hands on a physical bar for a few weeks. If there were plenty of silver, lease rates would be near zero. A high lease rate is the market screaming, "I don't care about the price, I need the metal now." This is the liquidity crisis that the headline inventory numbers hide. The visible mountain of silver is mostly frozen in ETFs and private hands. The tiny stream of liquid metal that remains is being sucked dry by the Shanghai vacuum. So, how does the metal physically move? The mechanics of the exodus further complicate the situation. When a decision is made to ship metal east, it rarely goes direct. London good delivery bars are roughly 1,000 ounces and often 999 fine. The Shanghai Gold Exchange prefers 999 fine kilos. This means the bars must be routed through Switzerland. The Swiss refineries are the conversion engines of the world. They take the big, crude Western bars, melt them down, purify them to 4 nines, and recast them into the smaller kilo bars preferred by Asian markets. But here's the choke point: refining capacity. Swiss refineries are currently fully booked processing gold and silver d'or from miners. They do not have infinite capacity to recast existing stockpiles. We are seeing queues forming at the refineries. Delivery times for recasted bars have extended from weeks to months. This physical bottleneck prevents the infinite arbitrage that textbooks predict. Even if you have the money to buy all the silver in London, you cannot physically transform it into Shanghai silver fast enough to crash the premium. This delay is fatal for the paper market. The paper market trades in milliseconds. The physical market trades in months. The $8 spread exists because the paper market is pricing in a liquidity that doesn't exist, while the physical market is pricing in the reality of the bottleneck. And remember the export quotas we discussed earlier. China knows about this bottleneck. By restricting exports, they ensure that once the metal makes this arduous journey through the Swiss refineries and lands in Shanghai, it stays there. They are building a roach motel for silver. It checks in, but it doesn't check out. We have seen this movie before. In the late 1960s, there was a mechanism called the London Gold Pool. The Western central banks tried to keep the price of gold pegged at $35 an ounce. But the free market knew gold was worth more. So European nations kept exchanging their paper dollars for physical gold and shipping it out of Fort Knox. The drain was relentless. The spread between the official price and the real value became too great. Eventually, in August 1971, the vault was practically empty. Nixon was forced to close the gold window. He declared that dollars were no longer convertible into metal. We are approaching a silver window moment for the COMEX. The COMEX exists on the promise that you can exchange your paper contract for physical metal. But as the registered inventory drains and the Shanghai premium incentivizes every loose ounce to leave the system, the exchange faces a mathematical impossibility. They cannot deliver what they do not have. When the registered stocks hit zero, or effectively zero, the exchange will have only one option: cash settlement. They will change the rules. They will say, due to extraordinary circumstances, we are settling all open contracts in cash at the closing price of $58. If you are holding a paper contract, you will get your dollars back. But you will turn around to buy actual silver, and you will find that the real price, the Shanghai price, the street price, is $75, $80, or $100 an ounce. You will have your currency, but you will have lost the asset. This is the ultimate consequence of the vault drain. It is the forced conversion of paper holders into fiat holders right at the moment of maximum inflation. We have established that the arbitrage is broken. We have proven that the vaults are draining. Now we must confront the final permanent reality, bifurcation. We are entering a period of permanent market split. The two-tier market we have long predicted is no longer a theory. It is the operating reality of late 2025. Tier 1 is the physical market, anchored in Shanghai. This is where the real price of silver is discovered. It is a price determined by industrial necessity, strategic accumulation, and geological scarcity. The $66 price we see today is not a ceiling, it is a floor. As long as solar factories need paste and mines are struggling to maintain output, the pressure on this physical price will be relentless and upward. Tier 2 is the paper market, anchored in New York and London. This market is becoming a zombie. It is walking, it is trading, but it has lost its soul, its connection to the physical commodity. The spot price you see flashing on a terminal, $58, is fast becoming a reference rate rather than a clearing price. Think of it like the official exchange rate in a failing economy. The government says the rate is 1-to-1, but on the black market, the real market, the rate is 10-to-1. The COMEX price is the official rate. The Shanghai price is the street rate. And just like in those failing economies, the goods disappear from the official market. You cannot buy bread at the official price because the shelves are empty. Similarly, you cannot buy volume silver at the COMEX price because the metal has moved to the market that pays the true value. This bifurcation destroys the credibility of Western financial pricing. For decades, the West enjoyed the exorbitant privilege of setting the price of global commodities. That privilege relied on the ability to deliver the goods. Now that the goods are gone, the pricing power is gone. We are seeing industrial users in Europe and the US beginning to reference the Shanghai price in their private contracts. A solar manufacturer in Germany doesn't care what the COMEX price is if he can't get metal. He cares what he has to pay to get a shipment from a refinery. And that refinery is looking at Shanghai. The spot price is dead. Long live the premium. What happens when the tension snaps? What is the trigger event? We believe the trigger will be a delivery failure at the COMEX. The COMEX exists on the premise that any contract holder can, in theory, stand for physical delivery of the metal. In practice, very few do. They roll their contracts over or settle for cash. But the threat of delivery is what keeps the paper price tethered to reality. What happens when a major industrial user, perhaps a Western tech company panicked by the Shanghai premium and export quotas, decides to bypass the line and stand for delivery of 10 million ounces on the COMEX? They look at the low inventory, they look at the high lease rates, and they say, I want my metal now. If the metal isn't there, because it is in eligible status and the owners won't sell, or because it has already been shipped to Switzerland, the exchange cannot simply print more silver. They will be forced to invoke force majeure or emergency protocols. They will declare that delivery is impossible due to irregular market conditions or supply chain disruptions. And here is the critical risk for the retail investor holding unallocated silver or ETFs, the cash settlement. You may not receive the silver you anticipated. You could be handed a check for the paper price on the day of the settlement, let's say $58. Meanwhile, the real physical metal will be trading in the physical marketplace for $80, $90, or $100 an ounce. You would be cashed out in currency precisely at the moment the asset you sought to hold is revaluing upward. This is not necessarily an error in the system. It is a structural reality. The clearing markets are designed to protect the stability of the exchange and the institutions. When physical inventory becomes critically low, the system prioritizes systemic stability over individual contract delivery. We have seen indicators of this already. In December 2025, during a price surge, trading was paused due to technical infrastructure issues. These interruptions often coincide with periods where selling pressure on physical inventory becomes acute. They are early warning signs of market stress. The consequences extend far beyond investment portfolios. This is a matter of strategic resource security. Silver is no longer just money, it is the electric metal. It is essential for the green transition, the defense industry, and the digital economy. For decades, strategic stockpiles were reduced, under the assumption that the open market would always provide liquidity. But with export adjustments in the East and premiums absorbing the global float, supply chains are being reassessed. There is a realization that key supply lines run through international vaults. We mentioned earlier that the U.S. Geological Survey added silver to the critical minerals list in late 2025. This is an admission of strategic vulnerability. Now, there is a need to rebuild stockpiles in a tight market. Imagine the government attempting to secure 100 million ounces for future production. Entering the open market now would significantly impact prices. Attempting to source via the COMEX could stress the exchange. Therefore, it is likely to happen quietly through off-market transactions or by prioritizing domestic mine output. We could see frameworks requiring miners to sell exclusively to strategic partners, bypassing the open market. This would fundamentally change free market pricing. The supply would be effectively allocated to strategic sectors, leaving less inventory for the private investor. The bifurcation isn't just east versus west. It is strategic sector versus commercial market. Governments and industries will secure their metal first. Private investors will be left competing for limited availability at prices that may differ from the spot chart. The Shanghai arbitrage spread is not a temporary anomaly. It is a signal that the era of financialized silver is shifting to an era of strategic silver. The Western markets have focused on contract trading and currency stability. The Eastern markets have focused on industrial expansion and physical accumulation. Now, the market is balancing. The $8 spread is the cost of this transfer. It is the premium paid for physical control of the asset. The market structure has shifted. The flow of metal has accelerated. The only question remaining for any market participant is which side of the asset class you are standing on. Are you holding paper instruments, ETFs, unallocated accounts, futures contracts that may track a reference price? Or are you holding the physical asset, the sovereign coins, the bars in your possession, that is being revalued by global demand? The window to exchange paper for metal at anything close to the current paper price is closing. The Shanghai market is indicating the future trend. The New York market is reflecting historical pricing, and the gap between them is where the significant financial movement of our time is occurring. Do not expect the arbitrage to close simply. Watch for the market to realign.